In this session, we are going to discuss about central banking system in India. So, I am Professor Anuradha Jain, faculty and professor of economics at Vivekananda Institute of Professional Studies. Will take you towards what was the evolution and what was the need of establishing central bank in India, that is Reserve Bank of India. The Reserve Bank of India was established in the year 1935 in accordance with the Reserve Bank of India Act 1934. The Reserve Bank of India is the central bank of India entrusted with a multidimensional role. It performs important monetary functions to regulate the issue of banknotes and the keeping of reserves to secure monetary stability in India, and generally to operate the currency and credit system of the country to its advantage. Initially, the Reserve Bank of India was a private stakeholder or shareholders company which was nationalized in the year 1949. Its affairs are governed by the Central Board of Directors appointed by the Government of India. Since its inception, the Reserve Bank of India had played an important role in the economic development and monetary stability of the country. Now, prior to its existence, Imperial Bank of India from SBI was conducting the role of the central bank. The Royal Commission on Indian Currency and Finance, appointed on August 25, 1925, suggested the establishment of the central bank in India. Later, the Indian Central Banking Inquiry Committee 1931 stressed the establishment of the central bank in India. Then after that, the Reserve Bank was established on April 1, 1935 under the Reserve Bank of India Act 1934. Originally, it was a shareholders bank which was taken over by the central government under the Reserve Bank Act 1948, that is paid up capital of rupees 5 crore at that time. Then the Reserve Bank of India was nationalized in the year 1949 and all shares were transferred to the central bank, central government. The central office of the Reserve Bank of India was initially located in Calcutta, which was later shifted to Bombay. Now, central banking as a concept, if we see, is of fairly recent origin. Though some Latin American countries had a central banking system in the 19th century, this system really became popular in the early 20th century. Generally speaking, a central bank is considered as the leader of the money market, but several economists emphasize different roles of the central bank, like it performed the function of like lender of last resort, stability of the monetary standard, credit control, etc. The Bank of England, founded in the year 1694, is perhaps the oldest central banking institution which provides finance for the government. The first attempt at central banking in India dates back to General Bank in Bengal and Bihar, that is 1773, at the instance of Warren Hastings, the governor of Bengal. But this experiment was very short-lived. 3 presidency banks were established and started functioning in 1866. Along with their commercial functions, they undertook some functions on behalf of the government also. But these presidency banks were amalgamated in 1921 to form the Imperial Bank of India, which was primarily a commercial bank but used to perform certain central banking functions as well. In 1926, the Royal Commission on Indian Currency and Finance, that is under Milton Young Commission, recommended the dichotomy be ended and the establishment of the Reserve Bank of India as its central bank. A bill was then introduced in the Legislative Assembly in 1927, which was later dropped. In the meantime, during 1930-31, consideration for constitutional reforms in the country started being debated. Ultimately, The Reserve Bank of India Act was passed in 1934, part of which came into operation in 1935 and the remaining part in 1937. It took over the management of currency from central government and of carrying on the business of banking in accordance with the provision of the RBI Act. Now, as stated in the preamble of the Act, the RBI has the responsibilities of, first of all, regulating the issue of banknotes, keeping of reserves with a view to securing the monetary stability in India, operating the currency and credit system of the country to its advantage. RBI has its central office in Mumbai and other offices in Calcutta, Delhi and Chennai, and branches in most of the state capitals and departments at a few other important places. The matters of policy relating to banking, monetary management, exchange control, inspection and supervision of banks, credit control, and economic and financial matters are formulated at the central office of the RBI at Mumbai. The basic function, if we see, of note issue and general banking businesses are discharged by the issue department and banking department at the local offices branches at every places. The RBI was initially designed on the pattern of Bank of England, theoretically subordinate to the Treasury. The governor, deputy governor, all directors of the central board and the local boards are either appointed or nominated by the central government. The governor and deputy governor are whole-time officials and hold office for such term not exceeding a couple of years as may be fixed by the central government and are eligible for reappointment also. They may, however, be removed from their office by the central government at any time. This legal provision has made RBI an almost subordinate agency of the Ministry of Finance, Government of India. A local board is formed in each 4 zones consisting of 5 members appointed by the central government. There is a chairperson of the board who is elected among the members. So, the local board advises on matters referred to it by the central board and perform duties delegated to it by the central board. And there are several models of central banking. The dominating models are, to name few, like Bank of England, which is a theory as stated earlier subordinate to the Treasury, but in practice has a relationship of cooperation rather than subordination. And this model can be called the functionally independent model of the central banking. Next comes the Federal Reserve System of USA, and this system can be said to be both functionally and statutorily independent. Then Deutsche Bundesbank, Germany, this can be said to be constitutionally and functionally independent structure of the banking system. The organization of RBI was modeled on the pattern of Bank of England as being the subordinate of the central government at a time when imperial power wanted to have positive and definite power centralization. But continuation of the same structure in a democratic setup may be examined in view of the need for a strong monetary system. And this requires an autonomous institution to cooperate with the central government, for laying down a strong monetary system. Now, RBI in India, if you see, then the policy which is adopted by the Reserve Bank of India is known as monetary policy. So, RBI works as a monetary authority of India by operating this monetary policy. And the Reserve Bank of India announces monetary policy every year in the month of April. This is followed by 3 quarterly reviews in July, October and January. But RBI at its discretion can announce the measures at any point of time as and when required depending upon the economic condition of the country. The annual monetary policy is made up of two parts. Part A, like macroeconomic and monetary development. Part B, actions taken and fresh policy measures taken or adopted by the bank, by the Reserve Bank of India. Now, monetary policy of the RBI deals with almost all other vital topics such as financial stability, financial markets, interest rates, credit delivery, regulatory norms, financial inclusion and institutional development, etc. Monetary policy objectives, if we refer, then monetary policy refers to an umbrella of operations used for the control of money supply in the economy with a broad objective to maintain economic and financial stability, because economic and financial stability is the most important objective of monetary policy, because the growth of the economy depends upon the economic stability and financial stability of the economy. It ensures adequate financial resources for the purpose of development. These objectives of monetary policy in India have gone through a process of gradual evolution and can further be explained to, like maintaining price stability, adequate flow of credit to productive sectors, promotion of productive investment and trade, promotion of exports and economic growth. Now, principal objective, if we explain in detail, then the following are the main principal objectives of monetary policy. Apart from financial stability, economic stability, which is the main center point of any monetary policy of any central bank of any country. So first here is the full employment. Full employment has been ranked among the foremost objective of monetary policy. It is an important goal not only because unemployment leads to wastage of potential output, but also because of loss of social standing and self-respect of the system. So therefore, controlling unemployment is very, very important objective of not only the monetary policy, but also the fiscal policy of any government. Next objective is price stability. One of the policy objectives of monetary policy is to stabilize the price level. Both economists and laymen favor this policy because fluctuations in prices bring uncertainty and instability to the economy. But here price stability does not mean that price will remain fixed throughout, but there should be only gradual increase in the price, very low rate, because low or moderate rate of inflation is always welcomed and accepted by the economy. But very high fluctuations in the price level will bring instability in the economy and uncertainty will be created, and because of that there will be various other negative impacts on the economy. So price stability is again one of the major objective of the RBI or Central Bank of India. Another objective is economic growth. So this is again important objective of monetary policy in recent years has been the rapid economic growth of an economy. Economic growth is defined as the process whereby the real per capita income of a country increases over a longer period of time. And all other objectives, whichever we discuss, whether we talk about price stability, we talk about unemployment. So all these are to achieve, or the target is to have more economic growth rate. Another objective is balance of payment, because this objective of monetary policy since 1950s has been to maintain equilibrium in the balance of payment. Because if your balance of payment is not in your favor, or if it is always deficit and more deficit, then that will have again negative impact, because your foreign reserves will go down. That will have an impact, negative impact on your exchange rate, which in turn will have negative impact on the growth of the economy. So, balance of payment equilibrium is again very important objective of monetary policy. Now, if we talk about in brief, like what are the instruments that monetary policy has to achieve these objectives or the targets. The instruments of monetary policy, we can say, are the tools or devices which are used by monetary authority in order to attain some predetermined objectives. So, there are two types of instruments of monetary policy. One is quantitative instruments or general instruments, and the other is qualitative instruments or selective credit control. The quantitative instruments are also known as the general tools of monetary policy, and these tools are related to the quantity or volume of the money. They are designed to regulate or control the total volume of bank credit in the economy. And these tools are indirect in nature and are employed for influencing the quantity of credit in the country. The general tool of credit control comprises of the following instruments like bank rate policy, open market operation, variation in the reserve ratio, etc. So, if we talk about bank rate policy, then the bank rate policy is a very important technique used in monetary policy for influencing the volume or the quantity of credit in the country. The bank rate refers to the rate at which the central bank, that is RBI, rediscounts bills and provides loans or advances to commercial bank against approved securities. So, it is the standard rate at which bank is prepared to buy or rediscount bills of exchange or other commercial papers eligible for purchase under the RBI Act. The bank rate affects the actual availability and the cost of the credit control. If the RBI increases the bank rate, then it reduces the volume of commercial banks borrowing from the RBI. So, it deters banks from further credit expansion as it becomes a more costly affair now because of the increase in the bank rate. Now, even with increased bank rate, the actual interest rates for short term lending go up, checking the credit expansion. Now, on the other hand, if the RBI reduces the bank rate, then borrowing from commercial banks will be easy and cheaper, and this will boost credit creation. Thus, any change in the bank rate is normally associated with the resulting changes in the lending rate and the market rate of interest. So, however, the efficiency of the bank rate as a tool of monetary policy depends on the existing banking network, interest elasticity of investment demand, size and strength of the money market, international flow of funds, etc. Another instrument is open market operation. The open market operation refers to the purchases and sale of short term and long term securities by the RBI in the open market. And this is very effective and popular instruments of monetary policy. And open market operation is used to wipe out the shortage of money in the money market to influence the term and structure of the interest rate to stabilize the market for government securities, etc. So, if RBI sells securities in an open market, commercial banks and private individuals always buy them. This reduces the existing money supply as the money gets transferred from commercial banks to the RBI. Now, contrary to this, when RBI buys the securities from commercial banks in the open market, then commercial banks sells it and get back money they had invested in them. So, obviously, the stock of money in the money market increases. Normally, during the inflation period, in order to reduce the purchasing power, the RBI sells securities, and during the recession or depression phase, it buys securities and makes more money available in the economy through the banking system. So, thus under open market operation, there is continuous buying and selling of securities taking place, leading to changes in the availability of credit in an economy. However, there are certain limitations that affects open market operation with underdeveloped security market, excess reserves with commercial bank, indebtedness of commercial banks, etc. Next instrument is variation in the reserve ratio. The commercial bank have to keep a certain proportion of their total assets in the form of cash reserves. Some parts of these cash reserves are their total assets in the form of cash. Apart from these cash reserves, gold and foreign securities are also to be kept with the RBI for the purpose of maintaining liquidity and controlling credit in an economy. So these reserve ratio are named as cash reserve ratio and statutory liquidity ratio, that is CRR and SLR. CRR refers to some percentage of commercial banks' net demand and time liabilities which commercial banks have to maintain with the central bank. And SLR refers to the percentage of reserves to be maintained in the form of gold and foreign reserves. Any change in VRR, that is CRR or SLR, brings out a change in commercial banks' reserves position. Thus, by varying VRR, commercial banks' lending capacity can be affected. So, changes in the VRR helps in bringing changes in the cash reserves of commercial banks, and thus it can affect the bank's credit creation multiplier. So, RBI increases VRR during inflation to reduce the purchasing power and credit creation. But during the recession or depression, it lowers the VRR, making more cash reserves available for credit expansion. The qualitative instruments are also known as selective tools of monetary policy. So these tools are not direct towards the quality of credit or the use of the credit. So they are used for discriminating between different uses of credit. It can be like discrimination favoring export over import or essential over non-essential credit supply item. So this method can influence over the leaders and borrowers of the credit. The selective credit tools of credit control comprises of the following instruments like fixing margin requirement, consumer credit regulation, or publicity, credit rationing, moral suasion, control through directives, direct action, etc. So these tools are also important for credit control because they control a selective way, like what priorities to be set by the government, where they should give more loans and all. So the Reserve Bank is a non-political body concerned with the finances of the country. Now, when a power is given to such a body under a statute which prescribes the regulation of the banking company, it can be assumed that such power would be exercised so that genuine banking concern could be allowed to function as a bank. So, while institution masquerading as banks or those run or unsound lines or which would affect the interest of the public could be wiped out. The Reserve Bank's development role includes ensuring credit to productive sectors of the economy, creating institutions to build financial infrastructure, and expanding access to affordable financial services. It also plays an effective role in encouraging efficient customer services throughout the banking industry, as well as the extension of banking services to all through the trust of financial inclusion. So this was the brief about the evolution of central bank RBI in India and what are its major instruments to control or to bring stability in the economy. So thank you so much for your patience hearing. Thank you.